mid-August, and before that I've been at Statistics Netherlands for 25 years. And it's my privilege to welcome you all here, either in person or joining remotely, to the 10th IMF Statistical Forum. The forum is one of the fund's flagship events. It brings together statisticians, economists, the academic community, private sector leaders and policymakers from around the world to discuss cutting-edge issues in economic and financial statistics. And this year's topic fully belongs in that range. It promises interesting discussions on measuring intangible assets. But without further ado, it's my great pleasure to introduce our Managing Director, Kristalina Georgieva, who is at the moment at the G20 Summit in Indonesia, who will provide welcome remarks in the video.
Welcome to the 10th IMF Statistical Forum, focused on measuring the tangible benefits of intangible capital. A significant portion of innovation over the past several decades relates to products we cannot touch: vaccine formula, blockchain, data, artificial intelligence. This intangible capital is playing an increasingly important role in the economy. We also know that this type of global innovation will likely continue to accelerate. In other words, there would be more intangible capital in the future. And that would place in front of us big questions to answer. One of the biggest is, how can we measure things we cannot touch? Think about the largest companies in the world: technology companies, software or cloud service providers, online retailers, pharmaceutical companies. The difference between their market capitalization and the value of their tangible capital, buildings, machines, equipment, is significant. The difference is largely due to valuable intangible capital. Things like research and development, software, data, organizational capital, and brands are assets often missing from balance sheets. They're not only missing from business accounts, but they're also only partially available in our economic data. Why are they missing? One reason is that intangible capital is hard to measure. While there has been progress in measuring some elements of intangible capital, such as research and development and software, information on other intangible assets is lacking. And this is why this forum is important. Better measurement of intangible capital is critical in helping us to understand the drivers behind economic growth in a modern economy. And better measurement will help us make better policies to promote sustainable and equitable economic growth. Comprehensive estimates of capital investment help policymakers understand what is driving economic growth today and the sustainability of that growth into the future. Our statistics must reflect the shift from investing in things we can touch to things we cannot. An excellent example of why this is important is the mRNA COVID-19 vaccine. These vaccines were critical in helping to pull the world economy out of one of the largest declines in output in recent memory. The speed with which mRNA vaccines were developed benefits from decades of research and development. In other words, a foundation of investment over time. But the actual deployment happened fast and happened in an incredibly timely manner. So let me go to my next point: inequality. There is a growing concern that certain types of intangible capital and the income they generate are concentrated in a small set of large firms. From a policy perspective, we need to better understand how growth in intangible capital impacts the distribution of income. For example, how does the increased use of artificial intelligence impact the labor markets? Does intangible capital enhance economic mobility? Is there a way to design policies to help ensure that economic growth driven by intangible capital is inclusive? To answer these questions, we need to measure intangible capital so we can increase the tangible benefits to society. And this is what you are here for. I want to thank the excellent speakers at the forum for your contributions and for motivating us all to further improve our statistics. I wish you a fruitful discussion and look forward to hearing what you conclude. Thank you.
Thank you, Kristalina, for these inspiring words. And it's great to have a managing director that so values the importance of data and statistics at the IMF. Before I provide some background on the topic of this year, I would like to express our gratitude for the many high-quality papers that we received. It made the selection very competitive, and we believe that the result is a very good mix of topics and some excellent speakers and papers lined up for you. I'd also like to thank our staff for their big efforts in organizing this year's forum. I've seen personally how much work has gone in it, and I really want to thank you for everything that you did. I'm sure we'll all benefit over it the coming 2 days. So please follow us on Twitter and Instagram using #StatsForum, and feel free to send your comments, questions, and suggestions in the WebEx chat. So what is intangible capital, and how does it impact our lives? Well, basically, intangibles are assets that have no physical embodiment. You cannot touch or see them. And when you hear the word intangible capital, you can think of things like the formula for the latest wonder drug, mRNA, the software behind the app on your smartphone, or the movie that you streamed last night. And these are indeed intangibles that have value, intangible capital, but it's so much more than that, and we'll discuss that the coming 2 days. So, for example, we have marketing assets, including the power of branding, organizational capital like supply chains. Companies are creating management practices and company culture to be more efficient and productive in delivering goods and services, and this has a value. It's a form of intangible capital. But there's also firm-specific knowledge, for example, training that companies provide to the workers that's specific to that company, such as training to use custom-made software. Data, of course. The growing digitalization of the economy has highlighted the role of data in value creation. And data that has been organized so that it can be used by the firm, its production, is an asset to that firm. And of course, artificial intelligence cannot be forgotten here, combining data, algorithms, and software. It's a powerful asset. It's used already in many areas of society and economy, and it's our common expectation that it will only grow. And you can even think broader. Relations among members of social and economic groups are important. Many experts argue that social capital is also part of a nation's wealth. Of course, innovation continues to advance, and there will be new forms of intangible assets. For example, the metaverse may bring greater integration between our real and digital lives. Companies are already making investments so that they can reach their customers in the metaverse, and exploring how it can be used to enhance collaboration in hybrid and remote work environments. I'm not sure the next statistical forum will be in the metaverse, but I'm sure that these kind of developments will continue. So these are all examples of intangible assets. And intangible assets are not fully captured in statistics, as Kristalina said, but there are ongoing efforts. They're transforming how we socialize, how we work, and how we consume. They're literally all around us, though we cannot see or touch them. So they are still missing for large parts in our statistics. And the statistical community already includes some forms of intangible capital in macroeconomic statistics, for example, research and development and software. And this has been very beneficial because it enables us to, for example, estimate the contributions of R&D to economic growth. At the moment, the statistical community is in a very big joint effort updating the international statistical standards for macroeconomic statistics, the Balance of Payments Manual, the SNA. And this is obviously an opportunity to enhance our measurement of intangible capital by capturing new and growing forms of intangible capital like data and marketing assets. And we'll come back to that in the rest of the forum. So why is it so important to measure intangible assets? So why should it be measured in our statistics? And there are many reasons, but I'm going to mention 3 of them. First, if we do not start treating expenditures to create these intangibles as investment, we are mismeasuring some of our key economic indicators like economic growth and productivity. And GDP may look quite different if we take these intangible assets into account. Higher productivity enables economies to produce more goods and services with a given level of inputs. It's key to raising living standards and eventually translates into higher wages. So if we want to understand how to increase economic well-being, we need sound measures of productivity and understanding of the sources of economic growth. And as the MD stressed, we need economic growth that is inclusive. The second reason why it's important to measure intangible capital is that it has different characteristics from tangible capital, and these differences can have important implications for macroeconomic policy design. For example, a good idea, once conceived, can be located anywhere in the world. And unlike physical buildings and equipment, intangible capital is much easier to move across borders. We have seen that in the past. And this greater mobility of intangible compared to tangible capital means that tax considerations can influence the decisions of multinational enterprises on where to locate, where to relocate their intangible capital. And it's important to take this into account in the statistics to get the good picture. It can also result in a race to the bottom, where countries compete to attract these assets and the companies that use them, and that has, of course, important implications for international tax policies. Well, the third reason is that intangible capital is scalable, and the MD touched on that too. Unlike tangible capital, which can usually be used in only one place at a time, intangible capital can be used over and over by many different users in many different places at the same time. And this has important implications for competition policy, because scalability can enable firms that are very intensive intangibles to get very big, making it near impossible for others, new innovative firms, to enter these markets and challenge the incumbents. And once companies have made the investments in the intangible capital, they can be easily be used in many locations at little or no additional cost. So also for that reason, it's important to have a clear view and picture of intangible capital. So given the fact that it's still not measured well enough in our statistics, and given the fact that it's so important for policy to have it measured in our statistics, we organized this statistical forum around this topic. We wanted to bring together academics, statisticians, economists, and policymakers to ensure that we're measuring the right thing and we're measuring it in the right way. So we will not explore only how to measure intangible capital, but also the reasons why it's so important to do so. So let me go briefly through the coming 2 days, and I must say I'm really looking forward to join these sessions and see all the presentations and important inputs. In the first session, we'll have a panel of experts from academia and international organizations with expertise in a variety of policy areas to explore why it is important to capture intangible capital in our statistics. In session 2, we will explore some intangible capital not currently captured in our statistics, including the metaverse. In session 3, we will have compilers from national statistical offices present some early attempts at measuring intangible capital, including brands and data, important for the update of the standards. We'll also learn how the updated statistical standards recommend expanding the types of intangible capitals captured in our statistics. Then the fourth session will look at the implications that the increased prevalence of intangible capital has in our economy for policy, including tax, competition, and monetary policy. Session 5 will explore how statisticians can improve the tools they have to measure intangible capital, including developing better data sources, having better surveys. And we will conclude with a keynote speech by Philippe Aghion, who is a leading thinker on innovation as a driver of economic growth. He will provide a keynote address entitled "The Promise of the Creative Destruction Paradigm" that will draw on his new book, The Power of Creative Destruction, that advocates for creating a better capitalism by understanding and harnessing the power of innovation that disrupts, but that over the past 200 years also has lifted societies to previously unimagined prosperity. Deputy Managing Director of the IMF, Bo Lee, and Professor Aghion will engage in a one-on-one discussion tomorrow to explore this theme more deeply. But first, we'll start the Statistical Forum by a presentation by Janice Eberly. Janice is the James R. and Helen D. Russell Professor of Finance and a Senior Associate Dean at the Kellogg School of Management at Northwestern University. Her research studies investment and its financing, including durable goods, portfolio and education choices by households and capital investments by firms. Recently, her work has focused on intangible investment and its connection to innovation and rents. And from 2011 to 2013, she served as Assistant Secretary for Economic Policy at the US Treasury. So this talk by Janice will set the stage for the rest of the forum by presenting the rise of intangible capital. So please go ahead, Janice.
Thank you, Bert. Can you hear me all right and see me?
Yes.
Great, thank you. I'm going to share my screen with you. And there we are. Well, it's wonderful to be with all of you today. Good morning from Chicago, at least. So first, I want to thank our hosts for bringing researchers in various fields together, which is incredibly important to get us out of our silos around these important topics, but also together with policymakers who have important decisions to make, not only about measurement, but about economic choices, and particularly the type of issues that the managing director was emphasizing this morning, which will have profound effects on the global economy in the future. But coming back to intangibles, I always found it ironic when we were working from home during the pandemic, discussing vaccines in our Zoom rooms and posting conference video to YouTube, when someone would then ask, so you're working on intangibles, what are intangibles? It's been the foundation of our work and much of our economies for the last several years. And as I will discuss and will certainly come up over the next 2 days, intangibles are changing how we measure economies, but more than that, they're changing how we think about economies and hence feeding back to how we measure them. Intangibles were brought to the forefront of economics by implied empiricists, researchers who not only had their eyes on the data, but deeply have their hands in the data, and who saw a new class of expenditures that were not just expenditures, but were actually investments by firms. They would have long-lasting impacts on future output, and hence should be treated as investment that pays off in the future rather than expenditures that are consumed today. This research to begin accumulating those measures into asset values led others to realize how profound the impact could be. And for starters, that we understate investment in capital with further implications that we mismeasure many important values in the economy, like rates of return, monopoly rents, and economies of scale, that should instead be understood as either intangibles themselves or as the rate of return to intangibles. So as we move forward, we see even more that intangibles might change how we think about production. Since they are capital, they are by definition not tangible. That is, they do not have a physical presence, which leads to a new set of opportunities and challenges. So one of the challenges is this lack of physical presence, which is clearly an obstacle to measurement, since counting up machines in the old way that we might have added up equipment or underground cables. So intangibles tend to be not just mismeasured, but undermeasured. But the benefits of intangibles are still present in things like profits and GDP and valuations. So we measure their impact on profits, but we don't measure the intangible itself. So by omitting intangibles, we tend to overstate the value and the impact of what we do measure. That is, the returns to investment, the scale effects of capital, and Tobin's Q, for example, which has capital in the denominator, would all be overstated. They're persistent, and with much respect to the people who do this work, I would even say dogged efforts to document and reasonably estimate intangible investments and the stocks to overcome those kinds of biases. But this effort is also an opportunity to recast how we think about production. If intangibles have no physical presence, but they do indeed contribute to output, how does that work? And what role do they play in production? Importantly, this was implicit in the managing director's opening statement and in Bert's comments when we began. Intangibles tend to be non-rival in production. That is, they can be used in many different locations in the production of different goods and production lines simultaneously, which is profoundly different than physical capital. But they are also difficult to appropriate. That is, to protect the intangible from use by others. So this acts as a limit to the benefits of intangibles. So I want to start with some examples of the strides that have been made in measurement so far and how they are reflected in the data, and how failing to account for intangibles can mislead our statistics and our economic conclusions. And then I want to turn to new ways to think about production with intangibles. So these data show the work of Carol Corrado, Jonathan Haskell, and others who have really been leaders for many decades in the measurement of intangibles. These data are from their new paper from the summer of this year in the Journal of Economic Perspectives, which shows in the left-hand panel not the intangible growth itself, but the contribution of intangible growth to growth in output. So this is, on the left-hand side, you see the decadal averages for the EU in blue, for the UK in orange, and for the US in gray. And I've left out the financial crisis years because those tend to have a big impact on the endpoints of the decade. So we see 1998 to 2007 in the first set of columns, then 2010 to 2018, where there's a substantial increase in the contribution of intangibles to growth. And then the last set of columns separates out that acceleration. One can alternatively look at long-run trends, which are in the right-hand panel, which shows the trend over this period, which is clearly positive across all of these countries and sets of economies. The counterpart to looking at this increasing contribution of intangibles is to look at the declining role of physical capital. In the data I show here, this is for the US, and the addition of these data shows both firm-level data aggregated up to economy-wide data, and then the BEA, the national accounts data itself. And on the left-hand panel, you see the declining role of physical capital, that is property, plant, and equipment, where the investment rate is very volatile. That's one of the important features of capital investment, very cyclical, but clearly declining over time. And that raised a puzzle for many macroeconomists, because on the right-hand side, you see the average return to investment. That is, the profitability of physical capital is either stable or rising over time. So the counterpoint to ask is, how could physical capital be declining, or why would it be declining if in fact the returns to capital are rising? So one explanation could be that this high profitability reflects the rise in intangibles rather than the return to physical capital. So there's really not a puzzle between the two panels. On the right-hand side, what you're seeing is the increasing contributions of intangibles to profitability and to firm and economic growth, but that's not driven by physical capital. So physical capital share on the left-hand side is declining. But another explanation would be an increase in market power, so that we observe the high returns on the right-hand side, but firms have a more limited incentive to invest in physical capital, which we see on the left-hand side. That is, investment on the left reflects the marginal return to investment, but the average return to investment on the right-hand side is still rising. So with growing measures of intangibles, it's possible to examine both of these hypotheses, and even better, to examine them simultaneously, because they're not mutually exclusive ideas or hypotheses. And even more than that, they may be complementary, because greater intangibles in some cases may allow for market power or greater returns to scale. And I'll have more to say on that point as we go through the data. So in a co-authored paper with my colleague Nicholas Cruzet, we calibrate a model that has both intangible capital and the potential for market power, and use some of these new measures of intangibles that have become available to us to discipline the contribution of intangibles while still allowing for the possibility of market power. So on the left-hand side is a characterization of the results where we use a very narrow measure of market power, that is just R&D, or sorry, a narrow measure of intangibles, just R&D. And the stacked chart shows the contribution of each of these measures to the rise in Tobin's Q, that is the rise in firm value relative to its capital stock. So the lighter shades, the two top stacks in the first chart on the left, are the contribution of just R&D to overall firm valuation, which is about a third of the increase in Tobin's Q. The rest is accounted for by market power. And when we use a broader measure of intangibles, and this goes to the importance of broadening our appreciation on our understanding and documentation of intangibles, with a broader measure, those shares flip. So on the right-hand panel, the top two lighter stacks are the contribution of intangibles, which account for about 2/3 of the increase in Tobin's Q. We can do a similar calculation across industries. So we break the data down by consumer, services, manufacturing. But you see that the bottom two panels, high tech and healthcare, have the largest effect of intangibles, which may not be surprising, given that we know the important effects of R&D in the high tech sector and in the healthcare sector. We can also examine, using that framework, how these have changed over time and across industries. So the horizontal axis of these two panels shows the intangible share, and on the left it's the industry share. The vertical axis shows rents. So even within sub-industries, you see higher intangibles are associated with higher amounts of rents being accrued by firms. And in the right-hand panel, it shows the trend over time, which means that as intangibles have been rising, rents have been rising as well, even at the very disaggregated industry levels. So these findings suggest that intangibles not only need to be measured to give a clearer picture of the capital stock, But they may also lead us to some new conclusions about the economy. That is, they're not just inputs into the estimation, but perhaps we should recast what we estimate. So I'm going to give you just a quick sketch of a model that shows how we might think about non-rivalry and its implications among intangible capital. So typically, when we have physical capital, we think of units used one at a time, one place at a time, and held in ownership by that single producer. Now we can take a research finding, say, or the output of the R&D process that improves management of goods or distribution. And we would measure N, which will be the notation here for the intangibles, which is the spending on intangibles, and accumulate it to a capital stock. But that idea, that process, can be used in one location of the firm and then another and another, as we emphasized earlier, without compromising the first use or any of the intermediate uses. That liberates, if you think about the accumulation equation, intangibles from a traditional adding up constraint. So in our equation, you see this parameter rho. That governs the degree of non-rivalry. If rho is 0, then intangibles are just like physical capital, and you accumulate them into a capital stock that goes into the production function. But if rho is 0, then the same intangible can be used over and over again across different production units. And in our estimation, we allow rho to be 0 and 1, so we can have partial non-rivalry. Are there any limits to this process? Well, what we propose is there may be limits to whether the intangible can be appropriated as it is deployed across many different production streams. So for example, the intangible could be diverted or diluted by others. A brand deployed widely may be less effective as knockoffs, for example, and copies arise. Hence, the ability to exclude others and institutions like patent and copyright protections may play an important role in making intangibles more effective. So this leads to a trade-off where the firm or an investor may want to deploy intangibles broadly to exploit the non-rivalry rho, but in doing so is exposed to outside appropriation, which we characterize by a parameter delta. So there's a trade-off between the two. And just to give you a preview of the implication for measuring TFP is that measured TFP, the difference between growth in outputs and growth in inputs, depends not only on how much of the intangible N that we measure, but also the properties of the intangible, that is, the of non-rivalry rho you see in the purple box, relative to its ability to be appropriated, the parameter delta. So just to wrap up, what are the implications of this rise in intangibles, not only in measurement, but in economic power? First is to measure more broadly, which we all appreciate, that counting up machines is not enough, not only in the national accounts, which we have all emphasized, but I would also point to firm-level accounting. That is, if economists and statisticians can't do the economics of intangibles well, then certainly neither can investors who have a claim to those intangibles, nor policymakers who are making decisions about them. The properties of intangibles also suggest that we should rethink production and recast our estimation to allow for a difference between the capital that goes into production and the capital that is measured as the accumulation of investment. And finally, just some food for thought and other questions going forward. If intangibles are non-rival and can be used repeatedly, then what is scarce in an economy if an intangible can be deployed indefinitely? So in this way of thinking, it's the institutions that protect intangibles and the technologies that store intangibles like energy and resources that become scarce. And of course, the underlying innovation, the talent and the ideas that generate intangibles, and the important work done by the people who measure them. So thank you very much, and I look forward to the panel to follow momentarily.
So thank you, Janice, for this very inspiring talk. I think it's a clear call on us all, statisticians, economists, to measure intangibles in a good way, to support the analysis that you describe, and which are clearly very important, and I think we'll take up the challenge. So now we have a short break until 10 o'clock, Washington time. And then we'll start with the panel discussion. Why is it so important to capture intangible capital in our statistics? Janice will be part of that panel again. So, well, we all can grab a coffee now and start again in about 10 minutes.
Hi, everyone. We're about to start again. If you could take your seats, that would be great. Thank you.
So why don't people take their seats so we can resume? Welcome, I'm David Wessel. I'm director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. I am an expert neither in intangibles nor statistics, but I hope I can help guide this conversation, which is really intended to, as the theme of the conference presents, to make more tangible the benefits of measuring intangibles. It seems to me this is a subset of a much bigger issue. I used to work at the Wall Street Journal, and when we got a new CFO, the editor of the editorial page, a rather bombastic guy named Bob Bartley, looked at him and said, the problem you have here is the things that are most important to the Wall Street Journal are the things you don't know how to measure. And I think we all know that not only in intangibles, but in general, the parts of the economy that are hard to measure, think healthcare, the quality of healthcare, think education, are increasingly important. And so I think the challenge here is to figure out what it is about intangibles that's so important that makes it worth measuring. I'm kind of struck this morning as I see a lot of people in this room and a lot of people who are remote that maybe one of the intangible things we need to think about is what are the tangible benefits of people getting together in person instead of being remote. Maybe we'll test that and see whether the people who are in the room get more out of this conference than the people who chose to be at WebEx. And finally, I want to just remind us all that not everything that is intangible is valuable. And I think we just learned that with the recent collapse of FTX. We have a great panel here of people who have very different perspectives, which is, I think, why the conference organizers assembled this group. Kim Klossing is the Eric M. Zolt Professor of Tax Law and Policy at UCLA Law School, which she joined recently after a stint as the Deputy Assistant Secretary of the Treasury for Tax Analysis. Seamus Coffey from University College Cork, who was former chair of the Irish Fiscal Advisory Council, and who told me it was great to have an excuse to get out of the office and come here, so we're very glad he made the trip. Giovanni Della Riccia, of course, is the Deputy Director of the Research Department of the IMF. His expertise is in finance, not in statistics or intangibles, which is why he is invited. And then Pierce O'Reilly is head of the Business and International Tax Units at the OECD. And then after we have a conversation, Jan Eberly will join us and maybe respond to comments or answer questions from the panelists. I thought it would be useful if we started with the questions on tax, because as Jan mentioned, and the managing director as well, if it's hard to measure, it's hard to tax. And if the hard to measure parts of the business capital are growing, then that presents challenges. So Kim, I hope you're with us, and maybe you can kick us off, and then we'll turn to Pierce, and then to Giovanni, and then to Seamus. So Kim?
Can everyone hear me?
We can.
Okay,
we can see
fabulous.
you too.
Thank you for inviting me. Oh, good. Thanks for inviting me to this panel and for that introduction. I'm really sorry that I couldn't be there in person, because I am definitely one of those who hold that intangible doesn't quite match tangible in this particular context. So why is it important to capture intangible capital? I think we heard some really wise words earlier about how important yet poorly measured this is in terms of thinking about the economy as a whole, and even thinking about factors that underlie the distribution of income. But as David mentioned, intangible capital is also very important for tax policy, and I'm going to focus on that angle. And I'm just going to give you two examples today. So first, consider the question of whether the corporate tax is an efficient tax. We know it's a progressive tax, far more than labor taxes or other alternatives, since capital is much more concentrated in the hands of the well-off than is labor income. As one example, in the United States, the top 1% receive about 12% of labor income, but 52% of positive capital income. But what we don't always know is whether the corporate tax is an efficient tax. And to answer that question, we need to think about how it burdens the normal return to capital versus how much it falls on the above normal return to capital. And that above normal return includes rents, the fruits of luck, market power, risk, and that bundle of things. So taxing the normal return to capital can reduce investment and growth, which people would worry about. Taxing the above normal return is far more efficient. So to avoid taxing the normal return to capital, you can actually make simple changes in the tax code that do that. Adding expensing, for instance, exempts the normal return of capital from taxation. Ideally, you would also end interest deductibility if you're going to go in that direction. And then what remains of the corporate tax base is excess profits, or those that are relatively efficient to tax. Research by several different research teams has found that today's current corporate tax base is mostly not the normal return to capital. Instead, it's the above normal return. And the extent to which that is true has been increasing over time, partly because of changes in the code itself, but also in part because of changes in the role of intangible capital. And this has made the corporate tax, in my view, more efficient over time than it was a few decades ago. So the growth in intangible capital is part of what accounts for that trend. And one thing to note about intangible capitals is that the expenses that businesses undertake when they're generating intangible capital are almost always fully deductible when they're incurred. And sometimes, in the case of R&D, they're actually directly subsidized through the tax system. So one thing we can be sure of is that part of the returns to intangible capital that we are taxing through the corporate tax base are above normal, and thus likely relatively efficient to tax. And this suggests that the corporate tax can be both progressive and efficient, so we might want to think about how to strengthen that. And that brings me to the second insight about the role of intangible capital in tax policy, which is that it helps shape international tax competition and profit shifting across borders. So our international tax system was developed at a time when the location of capital was much easier to identify, much more tangible, and when tax avoidance was far less important. And although the tax system of yore was certainly not immune from tax avoidance pressures, the physicality of production made it easier to establish the source of mobile international income. However, as capital has become more intangible and as international tax avoidance has become more sophisticated, it's become easier and easier to separate economic profit from the activities that generate it. This has a number of important consequences. Perhaps most obvious, it costs governments serious amounts of revenue. Somewhat less obvious, profit shifting makes it so that many of our economic statistics are distorted or just plain wrong, including things like productivity, growth, trade balances, direct investment positions, and so forth. A lot of these are very much distorted by profit shifting. So if we want to have a corporate tax, which has the potential, as I mentioned, to be highly progressive and efficient, we need to tackle international tax avoidance. And ideally, the system should be reformed in a manner that makes the tax base less sensitive to where accountants and lawyers report the fruits of intangible and often invisible capital. The reforms suggested by OECD G20 inclusive framework process would do a better job of assuring some minimal amount of taxation for such intangible profits. This moves in the right direction. And these types of reforms can help make countries make better use of a revenue source that has the potential to be both efficient and progressive at a time that revenue is deeply needed for many fiscal challenges. So I think this conference couldn't come at a better time to help us understand intangible capital in the tax system as well.
Great, thanks. We'll get back to tax. But Pierce, do you want to pick up where Kim left off on the tax question?
Thanks, and thanks to you all for the invitation and the opportunity to speak. It's a super important topic. I mean, I'll start by echoing almost all of what Kim said, and I'm going to try and not duplicate where she already made really important points. On So two other reasons to think about why this is particularly important. One is that, I mean, we rely, as you saw in the earlier presentation by Janice, we rely on intangible capital for innovation. It's a driver of innovation, it's a driver of productivity, it's a driver of growth, but we don't really know well how our policies in general, but tax policies specifically as well, I'll talk about, how they work to support innovation and productivity through incentivizing investment in intangible capital. And why is that? Because we don't measure it well. So over recent years, in the international space, we've seen more and more countries implement policies to try to incentivize investment in intangible capital, but we don't really know how these work, whether they're incentivizing new investment, or whether they're simply causing investment to shift from place to place without firms making new investment on a global basis. And so that's specifically in the area of tax incentives like patent boxes, IP regimes that cause firms to shift IP, to shift intangibles from jurisdiction to jurisdiction in order to attract a lower tax treatment. And obviously, because intangibles are highly mobile, this is really possible. And we just simply don't know what the impact of that is happening. Is at a global level? Because oftentimes we can't measure the intangibles well. And I think that there is, more scope for tax policies that support investment and innovation and R&D, and we need that. But at the same time, when the tax incentives focus on the income from those intangibles, as opposed to trying to subsidize the expenditure on the processes that generate these kind of intangibles, we're into that space where there's a risk that, as Kim mentioned, the corporate tax system is not necessarily taxing the rents from these intangibles as much as it might. So this is an area where a lot of countries are moving. A lot of countries are feeling under pressure to compete with one another, but we don't have necessarily the body of evidence that we might have to try and turn countries in the direction of better tax policy. The next thing I'll say, again, following up on what Kim said, the international aspects of this are really important, and they're obviously a big driver of the OECD's work. So, countries' inability to grapple with the taxation of intangibles, I think, is really behind a lot of the international reform process. And there, I'd just like to draw attention to, again, the real consequences as opposed to the revenue consequences of tax avoidance, and also potentially of the efforts to combat tax avoidance. So we know that tax avoidance costs revenue, but also, when MNEs choose to invest in R&D or choose to invest in, what we refer to as DEMPI functions, so the development, enhancement, maintenance, protection of intangibles, that can cause them to shift their activities away from where the activities would have taken place in the absence of tax considerations. And that, we expect, and there's literature to show this, has negative impacts on productivity, on growth, on innovation, and on efficiency in general. And, there's also evidence to suggest that these impacts are potentially far larger than the revenue consequences. So, in many countries, corporate income tax is not a huge revenue raiser, but where businesses do their activities and whether those activities are as productive as they might be is a huge economic issue, especially in the intangible space. And so that's why trying to design policies that work well, especially in the intangibles area, and trying to avoid these mobility issues is really important and has important spillover impacts for the entire economy.
I want to get back to tax in a minute, but I wonder if you could clarify, Pierce, that last point you made. You mean, say, incentives to build an R&D facility and employ people, and say in China, may encourage multinationals to locate R&D there, even if that's not the best place to do R&D. That, without casting any aspersions on China, that's what you mean. I see.
Exactly. We should be wanting activity to happen where it, in the absence of tax, is best place to happen, and that's what we need to be thinking about when we're designing these policies.
I see. So Giovanni has some slides and has some comments on the relationship between where firms get their capital and their investments in intangibles.
Yeah, hi everybody. Good morning. Thanks for the nice invitation. And as David said, I'm no expert in on intangible capital or statistics, although I have an undergraduate degree in statistics, so I should.
Okay, sorry, I didn't mean to malign.
I hope I still remember some of it.
I was just trying to lower expectations so they would be dazzled by your presentation.
Expectations are very, very low. So I thought that I would, because of my lack of expertise, I would rather talk about how intangible capital may change certain economic relationships in our economies, and how it can be an opportunity, but also a challenge for growth. This will probably echo many of the things that Janice had in her presentation. So you should never start a presentation without a picture. So this here I'm charting is a little bit dated, but I'm charting the share of corporate intangible capital relative to tangible assets. It is the black line, and the red line is the share of commercial loans in banks' portfolios. And you see, you know, when you put it together, it's really striking. And the question is this just a spurious correlation, or there is a reason that we are observing these two opposite trends? So this is work that we did with some co-authors, but here they found in academia a few years back. And you can tell, you know, I said it could be that it's just spurious correlation driven by other factors. Or it could be that because intangible capital offers less value as a collateral, it's much harder, as we are discussing today, it's harder to measure, it's often associated with the people working for the company very closely. And so banks are a little bit skittish in taking it at face value as a collateral for a loan. You know, compare that to a building or to a machine that can be easily resold. And if this is the case, then of course you can think about this as a shift in the supply of credit to the corporate sector, because there is an additional intermediation friction that is not there with tangible capital. There is an alternative explanation that is just, you know, you need less startup capital when your technology is heavily reliant on intangible. And because of that, you need less credit. And so in this case, it would be an efficient reduction in bank lending to the corporate sector with no welfare problems. It's not a shift in the supply function, it's a shift in the demand function. So in a paper we published a couple of years ago, we really try to go to the core of these questions. So we use evidence from local markets, and the assumption here is that if the relationship is not spurious, because credit markets, at least for medium and small enterprises, are very local, you should see that the trend in commercial bank lending declining should be much more pronounced in regions and markets where intangible capital grew more. And then after we look at that, we can think about whether it's a shift in the demand or a supply function by looking at the conditions that these firms get from the bank. So if the cost of credit goes down and other conditions of lending become easier, then it's more likely a reduction in demand. If it's the opposite, a reduction in supply. So this is a different blue and red map from what you're used to, although I would argue that there is a significant correlation with the more common blue and red map. And so the red metropolitan areas here are those, the redder, the faster intangible capital has been growing. The bluer, the slower intangible capital has been growing. There is no surprise here. You can see that it's mostly on the coast, California, Route 128, and so on. So what are the summary of our results? So we actually do find a very strong correlation at the local level between the rise of intangible capital and the reallocation of bank portfolios away from commercial lending and in the direction of real estate, for example, and mortgages, and also government securities. This can explain, so the rise in intangible capital explains between a quarter and 40% of this change in bank portfolios. And we do a lot of robustness tests to check that we are not capturing a reverse causality in the sense that you could think about the following. Imagine that banks are contracting credit. So okay, for whatever reason, credit is less available. Intangible capital, as I said, requires a less upfront investment. And so this would favor technologies that are heavy in intangible capital. But we look at this, and this is actually not going on at all. We look at banks that have capital problems themselves and had to cut credit. And in those regions, we didn't see any effect on intangibility. So the reverse causality is out. The second point is that I want to show is that firms with more intangible capital end up paying higher interest rates and have smaller loans than firms with more tangible capital. And this points in the direction of the supply shift rather than demand one. And here you can see that the net leverage, on the left-hand side, I'm charting net leverage of the corporate sector against intangible capital again. So the net leverage is going down dramatically. And if you partition companies by deciles according to their capital intangibility, you see that the firms with more intangible capital are hoarding a lot of cash. And they would not be hoarding a lot of cash if credit were readily available. So the fact that Google sits on, I don't know what the most recent number is, but hundreds of billions of cash assets makes you think, rather than distributing, makes you think that there is a reason in terms of their ability to borrow when they need to. So why this matters? Well, from a structural point of view, you can think about how efficient our economy is going to be if we don't develop a methodology for banks to use intangible capital as collateral. And the reduction in credit may create inefficiencies at the structural level. At the cyclical level, there is also evidence by one of my co-authors that companies that rely heavily on intangible capital react less sharply to monetary policy surprises. And so the management of the cycle from a monetary policy point of view becomes more challenging because you have fewer and fewer sectors that react sharply to changes in interest rate, and you end up relying more and more on, say, construction and on the household sector. And we have seen this in the past with the high-tech companies, but as intangible capital becomes more important in more sectors, this is a trend that is going to continue. And I'll stop there. Thank you.
Thank you, Giovanni. Can I ask you two questions? One is, so the universe you studied is the United States?
Yes.
Yes.
Well, there is evidence for Europe that is
right,
very
but
yeah.
The United States, in general, business is less dependent on banks than, say, Europe. So if intangible capital is increasingly important and banks have a hard time figuring out how to lend it against it because they can't measure the collateral and they charge more, doesn't that pose problems for bank-centric economies like those in Europe?
Yeah, so in our sample, we have a lot of small and medium enterprises that do rely on the banking system a lot. So to some extent, it's a little bit more European. But I think that there is a point. The question is whether arm's length financing and bond markets are any better than banks at using intangible capital as to evaluate the credit worthiness of a company or to establish some degree of collateralization for the bonds.
Right.
It's not clear that that would be better. I see it as a general challenge for financial intermediation because you have less collateral. So secured lending is going to be less available, and you have to go more unsecured, which means smaller loans and higher interest rates.
And the other thing you said in passing that it struck me, I wasn't quite sure I followed. So I get the point. Obviously, if all your assets are your employees, you can't go to the bank and mortgage them. Fortunately, we did away with that when we did away with slavery. But you think Google has a lot of cash because it can't borrow?
Okay. Maybe Google is the wrong example. But the question is how much you want to borrow relative to the size of the company.
I see.
And I'm not saying that Google cannot go and get a $10 billion loan. Of course, they can. The question is, relative to, say, I don't know, Standard Oil in 1930, what is their ability to lever up on the financial sector compared to their size.
I see.
And I think, I'm not saying that the only reason for the large cash pools of these companies is that they are afraid that they cannot borrow. But it may be one factor.
I see.
And it's not just the Googles of this world, it's much smaller companies
I
too.
see. Okay, so Seamus, I think you're going to talk a little bit about taking this to the national level and how Ireland has dealt with this. I couldn't help thinking when I saw you on the program that like every chart you see of OECD comparisons has some asterisk where they take out Ireland because all this intangible stuff draws the numbers all over. So I hope you're fixing that.
Yeah, thanks very much, and thanks for the invitation to contribute here today. And as David said at the start, delighted to take the opportunity to travel, although when I was here yesterday, I'm not quite sure how far from Cork it actually was with the rain that was falling from the sky. Given that we've two people from Ireland on the panel, it's clear there are sort of significant issues that are relevant from an Irish perspective. Now, my compatriot Pierce is very much involved on the tax side. I think what I want to focus on is a bit more on the statistical side, and like the Irish experience of some of the developments that have happened, particularly once SNA 2008 came into effect through ESA 2010 in the EU, and the changes and sort of the impact we see. Like, it's not necessarily that Ireland did things better or best, but I think it's clearly a case where Ireland was pretty much at the vanguard of much of this, where it was happening and visible when it came to intangible assets. Like initially, from an Irish perspective, one of the key changes with SNA 2008 was the capitalisation of R&D, and the fact that this activity wasn't intermediate consumption, that it actually led to the generation of assets. It led to the generation of fixed assets, albeit in intangible form. And from an Irish perspective, this became visible when companies started moving their intangible assets, particularly US companies, and changes in sort of international tax rules that meant it was no longer viable to maintain intellectual property in no tax jurisdictions, or in some cases in no jurisdiction at all. And Ireland saw a good share of that IP relocate and move to Ireland and be counted in Ireland's capital stock. So this sort of was a trigger for the inclusion of intangible assets in Ireland's capital stock. Now, Ireland was aided by the fact that it was transactions. Like, one of the issues that will arise over the 2 days we're here is the difficulties in valuing intangible assets. Now, the Irish Statistical Agency were aided in the fact that there was a transaction, that there was a number you could base it off and say this has now been added to Ireland's capital stock. And we saw the migration of things like patents, we saw licenses move to Ireland, be included in Ireland's capital stock. And it's important that they were included in Ireland's capital stock, because when the asset came, so too did the value. Like, so David mentioned this asterisk that goes beside Ireland in a lot of the data, and that's because Irish GDP is hugely elevated. Like, it's not that Irish GDP is wrong. It reflects the value of the capital and labour that's located within the jurisdiction. It's just that so much of that value comes from the intangible assets that have migrated to Ireland in recent years. It has no bearing on living standards. It has no bearing on the income available to Irish residents. So if you see something in relation to a percentage of GDP, which is the standard we all use when making international comparisons, it doesn't really hold up for Ireland. So you could say, for example, that Irish government spending is less than 20% of GDP. It might sound like that we've close to no government in Ireland. But if you look at the share of our national income, it's probably in the realm of 40 to 45% in line with international standards. So from a perspective of sort of the assets moving, Ireland had the advantage of those transactions and has led to valuations. Now, that doesn't mean that the valuations are consistent and remain consistent. Like, one issue is, of course, revaluations and the treatment of depreciation. So you can have a license and say, oh, that could be valuable over a period of 7 to 8 years. But like, does a brand depreciate? Does the value of a masthead or a trademark depreciate? And maybe revaluations are something that has to happen. And we haven't necessarily seen that yet in an Irish perspective. And we have seen some of those type of assets, those trademarks, brands, and mastheads also migrate to Ireland. But of course, they're not, in a sense, capitalized. They're not considered fixed assets. They're non-produced assets. Now, clearly, something goes into producing a brand, a trademark, or a masthead. It's not land. It's not oil. It's not a non-produced asset in that sense. And maybe one of the changes we'll see over time as standards are being revised is the movement of these type of currently non-produced assets, trademarks and brands, into the capital frontier. So from an Irish perspective, one thing we've seen is our capital account to the balance of payments, which I'd imagine close to nobody looks at, in Ireland is again something that's highly distorted because we've been buying these type of non-produced assets, and they are counted in the capital account. So from an Irish perspective, there maybe is again distortions that we're accumulating financial liabilities for assets that aren't on the capital frontier. And again, like these are produced assets, and maybe it's right that they should be capitalized. Then finally, from an Irish perspective, some of the major US companies that have headquarters in Ireland, of course, are very dependent on user data as a generator of their value, particularly some of the online advertising platforms. Many of them have been mentioned so far today, and a lot of them have their international headquarters in Ireland. And at present, in the Irish national accounts, or indeed the national accounts of most countries, little value is placed, little direct value at least, is placed on that user data. But of course, these companies are using that, using our preferences, using our choices, using our location as a key driver of the directed and targeted advertising that they're giving to us. That the value of the advertising they sell is boosted by the data that they have. Now, what value do we place in that from a statistics perspective? And more importantly, maybe, where do we place that value? Is it at the location of the HQ, the company that provides the platform that generates the online advertising? Should it be the location of the subsidiary that either is licensed or owns the data? So from an Irish case, many of those subsidiaries would be based in Ireland. Should it be where the data is physically held? Where is the data center? There's nothing in the clouds. The data center is somewhere physical. Should the data be allocated there? Or perhaps should it be allocated where the users are? That where our preferences are collated from, is that where the value is generated? Maybe going back to the tax line, some of the international negotiations on digital taxes, that value should be located where the eyeballs are, where the users are. But currently, no, at least from an Irish perspective, no direct value is placed on those. But clearly, that's something that is hugely important. We're at the opening session of 2 days here. We're not going to provide the answer this morning, but that's just 5 options as to where that value, which should be included in our national statistics, that's just 5 options as to where it could happen. So I think from an Irish perspective, we're likely to see ongoing changes, particularly when it comes to revaluations. We've seen the transactions with the assets come mainly from US multinationals revising their structures. But what happens now when some of those assets require valuations as they continue to generate value added and profits? The value of those assets should be revised. So I think Ireland will continue to be at the vanguard. When the next system of national accounts is updated, I think we'll be looking to see what Ireland will do. Not necessarily that we're doing it best, but perhaps it is just most visible.
When you say revalued, do you mean revalued up because they prove more valuable, or it can go either way?
So at present, there's consumption of fixed capital. So there's a difference between net and gross. So on an annual basis, the value was revised down. So if you look at the stock of intangible assets in Ireland, it's currently going down because the assets came 2-3 years ago.
And they're being
then you have the depreciated every year, and the net value of the stock is declining. But like the profit generated by those companies is still being maintained, in some cases increasing, and that suggests maybe that the value of those assets isn't declining, that you might have to do a revaluation. Whether you do it periodically or on an annual basis remains to be seen, but it is an issue.
And so just ask a kind of pretend naive question. Why are all these companies moving their intangible assets to Ireland?
I think we go back to why the other compatriot is on. It's very much a tax issue. Some of it is historic, like if you look at where the US companies had their intangible assets before, it was no tax jurisdictions. Your Bermuda, your Cayman Islands, or it was in some cases no jurisdiction at all. And those schemes are being unwound. Now, some of that intangible assets have moved back to the US. So there are some companies with operations in Ireland that are no longer paying royalty payments to Bermuda or Cayman Islands, and huge payments are going in that direction, where clearly no tax was paid. Now many of those payments are coming back to the US. So there's possibly some revisions to US statistics that could be undertaken in line with what we've seen in Ireland, because IP has moved from Bermuda back into the US. But a lot of it has come to Ireland. And why has it come? 1, historic, and 2, would be tax. The historic reasons are down to some of the things that were mentioned previously, that international changes in tax in recent years have been about aligning profit with substance. The companies had no substance in Bermuda. And in many cases, the key nexus of their substance was the headquarters in the US and the international headquarters in Ireland. And that was the choice that was available. So it's not a case of you could move it anywhere you want. You have to align it in some sense with the substance. So Ireland historically had the substance, and now has the intangible assets. So they are linking. But whether it would be better linked in the US, where much of the R&D actually takes place, is probably the case. So why has it come? I think history and tax.
Kim and Pierce, the deal is here, we can't see you unless you speak. So I'm going to ask you a couple questions, but I want to encourage you to join the conversation. And I think if you just start talking, we'll figure out you have something to say. But Kim, I wonder if two things that both of you. One is, so I suspect a lot of people in this room are more on the statistical side than the tax side. So can you explain to what extent does the systems of national accounts and all the statistics that we've been talking about today have relevance to these tax questions? And secondly, can you explain how some of the reforms that are under consideration might better align, as Seamus said, production with taxation and avoid some of the tax avoidance? Kim, why don't you start, and then I'll let Pierce follow in.
Yes, I mean, I think it's undoubtable that the presence of intangible capital and the way that that's facilitated tax avoidance has generated puzzles, is the nicest way to put it, in international statistics. And we've seen some of this in Seamus's work on Ireland, where, you know, there's been times where it looks like GDP growth is 30%, or it looks like, you know, there's a massive change in how much this or that international balance is working. And you might expect that to be a large problem in Ireland, but I also think it shows up in the US statistics. If you look at some of the work by a team that was part academics and part BEA economists, they think productivity growth is incorrectly estimated in the United States because of this problem. You have this sort of situation where what you think is real, like how much can you make in a country relative to the amount of inputs that you're putting in, you think that's a real thing that you should be able to measure, but it's being incredibly distorted by this. And I think this holds for a lot of our aggregate accounts. If you look at the US trade balance, I think it's probably misestimated by a large degree to the fact that profit shifting gives us an incentive to effectively create illusory trade deficits, because we're overpricing things that we're buying from low tax locations and underpricing things we're selling. And that's true for goods and services and a lot of intangibles as well. So, you know, I think this is a big task, but if international tax reform starts to level the playing field a bit. So imagine a world where everybody adopts a 15% global minimum tax. And there's some countries that are above that, maybe at 20 or 25. But you're compressing the incentives to do all of these distortions. So even if there remain some tax differences, the tax differences might be in the realm of, you know, 0 to 10% as opposed to 0 to 50%, right? And that's going to reduce these kinds of distortions. And, you know, and I recognize that there are real things that happen in Ireland, and, you know, that's different from some of the havens like Bermuda, which we might think of as having a lot less real activity. But it's quite clear that under the current status quo, while there's been some realignment, there's still an enormous way to go here. You still have kind of profit per employee in Ireland that's 10 times what it is in the United States. And it's true, like in a place like Gibraltar or Jersey, it might be 100 or 1,000 times what it is in the United States. And that's not an exaggeration in the country by country data. But there's still things that are misaligned, and so there's a long way to go. I don't think the reforms so far have fixed that problem, and so there's going to continue to be a lot of puzzles in GDP and productivity and international accounts, you know, for the foreseeable future.
You're making the case that our statistics are behavior that the tax code encourages, and I was sort of wondering about the other way around. To what extent do these national statistics, are they important in informing the policy choices on tax? Are they relevant or irrelevant?
I think the national statistics are always, you know, driving important policy decisions. I think I think the trade balance is a good example where it probably should drive it less than it does. Like you do see a lot of politicians paying attention to this statistic, which I personally think is some combination of macroeconomic factors like our savings and investment imbalances and some of these incentives I just spoke of. But it's still clear that people are targeting that. They're targeting that in a, ill-conceived, poorly thought out fashion. But they care about those numbers, and it's influencing our sense of like how successful the U.S. economy is. If productivity growth has slowed down a lot and we're mismeasuring that, and then we're saying, okay, well, we need to do this, that, and the other thing in response, then we might have a distorted view of reality.
So Pierce, you want to take those questions? What difference do statistics make to the tax debate, and what in the tax reforms that the BEPS and the other things that are in the works would address this?
Yeah, it's a good question. I'll give two relatively practical examples, one from the international tax reform and then one from just the international tax practice. I mean, to go a tiny bit into the weeds, or what I hope is a tiny bit into the weeds of the international tax process, Pillar 1 of the agreement that is, was agreed last October, and the details of which are being finalized now, said that, well, we want to take some of multinationals, profits that are associated with what we call residual profits. You could call them rents, but they're profits that are associated with intangibles. And the view taken by the members of the inclusive framework, so there's 140 members, is, well, the share of those profits that are associated with what we call marketing intangibles, so brands, eyeballs, user data, all of these kinds of profits, well, they should be taxed where those users are, where those consumers are. And that was, in many ways, the kind of the philosophy behind the reform. And a really hard part of the question, and I think something that we didn't have good data on, we needed better data on than we have or continue to have, is, well, how much are marketing intangibles relative to other kinds of intangibles? What is user data worth? So if Google's data is in Ireland for tax purposes, and it's not correctly valued, what size of that pie is France or the United States entitled to tax? If we say that, well, the data is being generated in France, the data is being generated in the United States as U.S. users, but it's in Ireland. If we decide we want to tax that in the United States or in France, wherever the user is or whatever the consumer is, or the person whose brand is sees an ad for Louis Vuitton and then believes in that brand, if that's in the market, well, how much are those intangibles worth? And I think that's not a question that we know the answer to well enough on an aggregated basis or on a firm by firm basis in order to make tax policy as accurately as we might have otherwise. And then second of all, I mean, I think the reason why we're doing this work in general is because tax practitioners don't know how to value intangibles in a way that will allow them to say, look, this is the amount of tax that you should be paying in my country. And when they go to look at, a multinational or a country by country report that a multinational might find in their jurisdiction, and they can't look at the amount of intangibles that are, coming into their or intangible income that's going from their jurisdiction to another jurisdiction, or that's in another jurisdiction that might have links to their jurisdiction, and then they don't know how to assess their profit shifting risks, but they also don't know how to assess really, well, how is the international tax system performing? And so I think that all of these statistics really perform a baseline function for trying to inform a debate about, well, how big of a problem do we have? What is the nature of that problem in the international tax system? How far have the existing reforms gone in terms of solving that problem? And what more do we need to do? But I think that a bit of that goes back to some of the points that Seamus was making, that there has been big progress in terms of the measurement of intangibles. Not all countries are as far as others. For certain countries where you see they've gone a bit further, you can see, okay, that improved measurement really makes a difference. But until that better measurement is more comprehensive, I think we're in part, I think, still going to be making policy in the dark.
I see. Do either of you want to, I want to move on from tax, but I want to make sure you have a chance to weigh in on it. Are you in favor of taxes or not?
Oh, absolutely. And I think taxes are clearly a key driver, but I think that the underlying approach of the tax system, at least, has to be to align profit with substance. And in many cases, we're better than we were 10, 15 years ago, with companies declaring lots of profits in no tax jurisdictions. But we're not fully there yet. Like, I think you can legitimately question, like, should US multinationals be able to move their intellectual property, intangible assets to Ireland? Yes, they have substance there, but do they have that much?
Right, right. Giovanni?
Yeah, no, I'll refrain from commenting on this.
On taxes? And I'm trying
David,
to... Please.
Sorry, I wanted to react momentarily to Pierce's question, because his comments, which are, I think, sort of a natural transition from the tax questions to some of the other economic and statistical measurement questions, which I took away from Pierce's remark about better data and getting user data as suggesting maybe measurement at the level of firms in addition to data. So thinking about accounting standards and, for example, breaking out SG&A, the sales, general, and administrative expense, so we see what firms are spending on brand and marketing, or we have some sense of their expenditures on data, so we can start to measure the value of data. Is that the natural implication of what you would propose for better data on users?
I guess I would hesitate, because I'm not an accountant, and so I don't know exactly what is necessary. But I mean, I know certainly, I mean, even at the sectoral level, I think that there would be a lot of value of additional data relative to what is there now. I know from a data analysis perspective, I mean, taxpayer microdata is always the holy grail, and it's seldom publicly available, and so on. And financial data is a great substitute, but I think even more granular data on a sectoral level, and certainly across a broader number of countries that are doing this in a more comprehensive way, is really important.
Jan, did you have any reaction to Giovanni's charts on the relationship between how firms finance themselves and their shares of intangible capital?
I did. I've seen that paper, and it's really interesting work. Actually, when you asked David about whether does this mean that Google is holding more cash because they can't borrow, I was thinking of a different implication, which is that if I think this is most prominently discussed in biotech, where you have small startups, and it's difficult for them to get financing based on their IP, because there's really no value to it until they go through, say, drug trials, right? Because of the regulatory requirements of actually going to market. So they actually do end up being quite financially constrained. And that may lead to less investment, though if they have a promising technology, what may instead happen is that the biotech version of Google that has a lot of cash then partners with them or acquires them in order to take drugs to market. So in order to be financially successful, you either need to have firms with a substantial amount of cash or a very diversified portfolio of potential drugs or projects. So it ends up that the large firms play an outsized role, and the fact that we have intangibles changes the market structure of the industry. So it's probably worth thinking about the whole industry rather than the implications one firm at a time.
But yeah, that's an interesting point. And on the question I raised, I asked Kim and Pierce, to what extent do you think It goes without saying, especially in this room, that we want to have better statistics because we want to better understand the economy. And Kim has made the point that there are some statistics, the trade balance was the example she gave, that tend to drive policy, and maybe more than it should. I think we've certainly seen that in the United States. I'm curious what you think the relationship is between better statistics and the measurement of intangible and policy. Does it really matter to policy? Why should we invest in statistics other than just to better understand the economy, which is a good reason? Jan?
Well, you might not be surprised that I think better measurement is really important for policy. The management
I want you to convince people of that. I want you to convince people of that, particularly the people who appropriate money to the U.S. statistical agencies.
Yeah, the management version of this is that you only manage what you measure, and in policy making, we can only make decisions based on what we measure, and everything else is speculation. So you look at GDP, and you look at GDP per capita, you look at distributions, and the data that is reported is much more powerful than some estimate that's based on an inference about what we don't measure. So it's what you can put in front of people seems like hard numbers, just like tangible capital seems like real capital. And having estimates change things from making a conceptual decision and into making, hard policy.
I see. Do you guys have thoughts on that?
I would add to that
I think. Oh, please, Kim.
Sorry. I would add to that I think sometimes people don't even understand what they're really doing with some of the policy instruments in a way that better measurement here would help. So you hear over and over again people talk about the corporate tax like it's a tax on machinery and plant and equipment. And to some extent, by law, we've already exempted a lot of those returns from tax, particularly if they're debt financed, we might even be subsidizing them. So understanding that a lot of the corporate tax base is driven by intangible capital and thinking about how that's taxed and what the incentives are there, I think would be hugely helpful. And also some of the work that Janice and her co-authors have done about explicating this connection between market power and intangible capital, I think is very important too, even beyond tax policy into the areas of antitrust, to better understand kind of where is this good for society and where is this potentially problematic and what are the tools that we have to deal with that.
Good point. So Seamus, can you talk a little bit about what's the relationship between these conversations among the experts in Ireland and the politicians? Is there any conversation? As Kim was saying, I think we all want to believe that better data and information would drive better policy. I think it would definitely push us in the right direction. It's clearly perhaps a necessary but not sufficient condition, at least here in the United States.
Yeah, great question. And there are important discussions. And I think like one thing policymakers do want is better data. And like from an Irish perspective, being within the EU and within organizations like the IMF and the OECD, you want to be able to make international comparisons. Like what are we doing relative to what happens in other countries? And as we've discussed, one consequence of the location of significant amounts of intangible assets in Ireland is that our standard macroeconomic measures don't necessarily reflect sort of the resources available to Irish policymakers. Like, should we be spending more on education and health? Well, if we were spending as a share of GDP, like it would be a huge amount of money. But the thing is, the policymakers can't get their hands on that money. A lot of it is generated by foreign-owned companies and should be and is attributed back to the headquarters and then subsequently on to the shareholders. Like Kim is right about the impact on some of the macroeconomic statistics. Like Ireland runs huge balance of payment surpluses. Ireland runs huge trade surpluses. But they're not necessarily resources that are available for Irish policymakers to allocate and say we should have this in health or in housing or in education or in social transfers. So you can see those huge surpluses and say, oh, sure, they're in a very strong position. But either it's linked to the intangible assets or linked to the foreign ownership of companies in Ireland, so it's not directly available. So there are important discussions. And what's happened in Ireland is that we want to be able to make those comparisons. We want to be able to say where we stand in international affairs. So we have bespoke measure in Ireland. There's a system of national accounting, there's ESA 2010. Like Ireland has a little appendix. Like what does the asterisk mean? Like from an Irish perspective, it means go to the appendix. We have measures that we actually put the asterisk on. So we have a national income called GNI star. We explicitly put the asterisk there to say, this is specific to Ireland. Like what our statistics office have done is try to strip out all of those other factors. Yes, they're important for measuring value added, they're important for measuring profits, but they're not necessarily important from a policy perspective in Ireland. So we have bespoke measures. We have a particular measure of our current account that strips out that. We have a particular measure of national income that strips out that. And our policymakers focus on that. So those discussions have happened. There's a recognition that these intangible assets are present. There's also recognition that it's not, maybe those profits aren't available for Ireland to spend. So I think our statistics office has done good work in measuring them, but these distortions can impact policy. But I think the discussions have been had to say we shouldn't be considering all that money to be ours.
So it's kind of interesting, the tone of the conversation about some of this is that we're understating productivity growth, and we're actually doing better than the statistical measures suggest. And the poor statisticians in Ireland have to convince their policymakers that the numbers look good, but don't spend this money because it's not really ours. Giovanni, I'm interested in how people in your field have come to think about the importance of intangibles as a research topic, as an issue in thinking about the world economy at the fund. Just how has that changed over time, and what are the challenges in that sphere?
Yes, so I think that from the corporate finance point of view, there's been a growing literature that started really with the structure of the balance sheet of companies, and that then spilled over into credit markets, banking markets, and so the relationship between the balance sheet of the corporates and the investors that were supposed to fund them. And now there are several papers that explore that. I think that, looking forward, I think this relates to the other enormous field that is fintech, that is coming up in finance. And I think it's going to be fascinating to think about how truly intangible things like, say, digital currencies are going to interact with this. And conceptually, the two things are very different. But so to think about the value of, say, the fund Libra project, it goes to many of the points that the people on the panel touched on. Where do you locate it? Is it the users? Is it Facebook, and where Facebook is located? It's going to be the subsidiary of Facebook that is running it. I actually thought about your previous question and how the ability to measure intangible capital affects the choices of politicians. And I think that it's going to be incredibly important in measuring the effects of policies. It's not just, oh, we have a lot or a little, but when you implement whatever policy you're putting in place, it's critical for politicians to see what the outcome is.
Right.
And if you don't have accurate measures, it's going to be very hard to evaluate different policy measures. So I think that...
Yeah, that's a really good point. It comes up in other spheres. We've had some conversations with the Congressional Budget Office about how do you model the returns to investment in young kids? And they said there's a lot of literature, but how do I know what the mechanism is? And your point on fintech is well taken. I was looking at the program and I thought, I'd just begun to get my head around the fact that R&D and people and brands and trademarks are intangible assets. And then I saw there's a paper in the next session on NFTs. And boy, if there's anything that actually is intangible, that's a count. Jan, we have a couple minutes left. And since you kicked us off so well, I wondered if you had any closing observations or questions you think we should have addressed that we didn't.
It's been a really fascinating and comprehensive discussion, and I learned a lot about tax along the way. I guess a question that was addressed partially is whether, the tax system, we will probably never wring out entirely biases resulting from the ability to locate intangible capital where it's most profitable, to locate it, or where it's most favorable to locate it. So if we're willing to concede that point, are there things we should be measuring that would enable us to sort of parse out the biases and let policymakers make good decisions nonetheless, or to, build other aspects of tax policy around the ability to locate intangible? So that was my remaining tax question. And then I liked your last question, David, about, where is research headed? I think that would be a good place to get people's last thoughts as well, if they have things to add.
Yeah, that's a good question. So Kim and Pierce, do you want to take Jan's first question as well as her second? One is, how do we make a imperfect tax system? How far can we go to perfect the tax system? And if there's one research question you'd like people in the room to pursue, what is it? Pierce, do you want to start?
I'm not sure we will ever completely manage the different sets of trade-offs in the international tax system. There is no perfect system because there's always trade-offs. But I completely agree with Janice's point that more information on those trade-offs is really important. I guess a research question I would like answered in a perfect world would be really what happens to the quality of investment in intangibles and the returns in terms of productivity and innovation that stems from those intangible investments when they're tax motivated. So that's a big question, but I'll stop there.
Kim?
Yeah, that's very good. My instinct on international tax is that we're always going to have to settle for rough justice, but that rough justice is probably still a lot better than the status quo if we didn't have reform. I think we can get to a point where we're better taxing activities where there's some claim to substance, whether it's on the market side or the supply side, is still better than just finding the lowest tax jurisdiction and putting the profit there. On research questions, I think one understudied area that I'd like to see more on is in this intersection between intangible capital, market power, and tax. Like I do think the people who study market power don't tend to think about tax and vice versa. And I think given how concentrated capital income is in our society, both at the individual and at the firm level, I think there's a lot more work that we could do in that overlap. So I guess that's my broad answer to that question.
That's a great. Jan, this is a great question. Now, can you guys give great answers? One research question you'd like the answer to.
Yeah, I think that what Kim just said, that the relationship with antitrust policy, I think, is not just an important research question and a fascinating one, but I would say critical policy question for the next 10 years. And I want to go back to Standard Oil. If you think about that this country, in an arguably less democratic environment in 1919, split up in, 20 different companies, the largest company in the country, I think that we can do it again. And but for that, you need a much better understanding of the technology and the value of the technology behind the giant tech companies.
Right, and how much is network effects that we want to encourage, and how much is path dependency?
And their measurement of capital matters enormously. On what is capital, and can you split it, is still valuable, and so on.
Right. Seamus?
On the research, I suppose one key area that will be addressed over the coming 2 days is on valuation. I think we maybe need more research on valuation methods, like the resale or replacement cost of a factory, say, or a commercial airline are reasonably consistent and can be assessed with relatively basic methods. Now, I know those doing depreciation and national accounts would say it's not basic, but there are pretty consistent ways of doing it. But when it comes to intangible assets, the valuation is key. And if the research kind of can poke into that and say, well, historically, what does kind of retrospective valuations tell us? Particularly when it comes to things like brands, it's very easy to say that these marketing assets should be capitalized, but much more difficult then to put a value on them. So I think the research goes in that direction, because like these values are highly volatile. Like you take over a social media platform and you start issuing tweets on your platform, the valuation can go up and down pretty rapidly.
Just to take for instance, yeah.
So like, I think the methods we have maybe need to be revised a bit to take into account that. So if the research could look at that, it's a difficult question. I don't think we're going to get the answer readily, but if people could get their teeth into that, I think, and progress could be made, there'll be significant value in that.
Great. Well, I want to thank you, both the people here and the 3 people remotely, for a lively conversation. And I'm sure that any of the authors, any of the speakers would be happy to entertain questions by email or in other conversations, including those who are here. And I think if I look at the program right, we have a coffee break till 11:30. So thank you all, and look forward to the next session.